Good morning and welcome to Fundamentally Speaking. I'm your host, Lance Roberts, and normally on Tuesdays we do Technically Speaking, but today I wanted to talk about something that, well, is an issue that is not so much a concern right here, right now, but is going to be a concern longer term. And since most of the time we're talking about long-term investing and managing money for the long term, it's important to really understand what those future returns might look like. And so I thought today we'd spend a few moments going through several different valuation measures and what those valuation measures are telling us about what to expect as investors, what our return will be over the long term. Let's start with taking a look at several different combined measures here. This is a chart that shows expected total returns from the stock market on an annual basis as compared to market cap to GDP, Tobin's Q, and CAPE ratio. I'm going to get into more of those in just one second, but what we understand here is that currently with the standard deviation of valuations where we are today, in other words, valuations are far above their long-term averages, that returns have historically been much lower going forward than they were in the past. But let's take a little bit of a closer look at this from two aspects. First of all, this is a chart of the S&P 500. I know it's a bit cluttered, but if you'll just bear with me one second, there's a real simple message here. No matter how you look at this chart right now, whether it's the amount of deviation of price from long-term returns, whether it's relative strength, whether it's deviation of price from long-term moving averages, whether it's valuations, or even if it's just the percentage of deviation, it doesn't matter. Every one of these measures say the same thing, which is that at every point in history where these vertical dotted lines are, these have been the points where all these measures aligned into one point in time where we are today, and future returns over the next several years have been subject to either short-term corrections, intermediate-term corrections like the crash of '87, or more significant bear market declines like we saw in 2000 and 2007. I'm not saying that a crash is going to occur tomorrow. This is a chart that goes back to basically 1944. It's a quarterly chart, so these things take time to play out, but just like valuations. Valuations are something that take time to play out. So let's take a look at some of these valuation measures currently and see what they're telling us. So this is Tobin's Q ratio, which is simply the measure of replacement costs for corporations over time, one being an exceptionally high level on this particular ratio. Whenever Tobin's Q has been above 1, forward returns over the next 10 years, which is represented by the blue vertical bars, have been substantially lower. With valuations currently well over 1 today, the expectation is that over the next 10 years, based on historical norms, that valuations and returns from stocks will be lower as these valuations revert back to lower levels. We can also take a look at the same thing using Shiller's CAPE ratio. This is the 10-year smoothed average of trailing earnings, right? So we see the same thing here, and you'll also notice here that Tobin's Q and Shiller's CAPE track very closely to each other. So not surprisingly, as we saw before, when valuations are well above 23 times earnings, which they are today, forward returns over the next 10 years tend to either be low or negative. This is something that we'll continue to see through basically every measure. If we take Shiller's CAPE ratio and adjust this for interest rates, one of the primary arguments over the last several years has been, well, elevated valuations are acceptable because of low interest rates. But if we adjust Shiller's CAPE for low interest rates, what we find is that argument actually is not true, and valuations adjusted for interest rates are exceptionally high levels, and with the expectation that forward returns, again, are going to be lower over the next 10 years. Same thing we see here for price to sales. While we can manipulate a lot of the bottom line earnings of corporations through things like accounting gimmicks, share buybacks, etc., the one thing we really can't mess with too much is the top line of revenues. In other words, what does the company sell? What do they bring in when they sell a product? What is their revenue at the top line? Before you get into all the other accounting measures, revenue tells you a whole lot about what the company is actually doing. And currently today, price to sales is at the highest level ever on record. In other words, investors are paying more today for sales of companies than ever before in history, and previous peaks in price to sales have been, well, not so good for investors over the next 10 years. Not surprisingly, we see exactly the same thing we're talking about in all the other valuation measures. Lower returns when you overpay for either sales or earnings, you're going to wind up getting a lower rate of return over time. The Buffett Indicator is the last one. It's market cap to GDP. And of course, as we look at this, this is Warren Buffett's favorite measure of valuation. Today, right now, when you take a look at the Wilshire 5000 market cap to GDP ratio, very broad measure of stocks versus the economy, we are at a level higher than ever before in history. So even Warren Buffett has to be understanding that forward expectations on what you pay for, since Warren Buffett's favorite saying is price is what you pay, value is what you get, is going to be substantially lower going forward. Maybe this is why he's sitting on over $100 billion in cash right now. You know, and even if we take a look at the inverse of the price to earnings ratio, which is more commonly known as earnings yield, it too tells us the same thing, that forward returns are likely to be lower, as even today, earnings yield on stocks are exceptionally low relative to the price that people are paying for a dollar's worth of earnings. Now, importantly, I want you to understand this. When we talk about low returns, I'm not talking about every year is going to generate 2% going forward here on out. That's not the way this works. What we are saying, though, is, and I've done an example table here for you, is that it's very likely going to result in a mean reverting event. In other words, a point in history where stock markets have a big correction in price, a la 2000, a la 2007, but it doesn't have to be a 50% correction. It can be something as simple as a 20% correction one year and a 15% correction in another year. But those corrections over a 10-year period, no matter how they come, result in lower total rates of return over time. As an example here, in the double dip idea, we have a 25% correction year 3 and 11% correction in year 7, and total net return over the next 10 years is simply 2%. Now, if I strip those two out, I would have had a 7% rate of return. That's what you would expect from the markets, but crashes do matter very much. And importantly, when you have a crash very late stage in that cycle, it really impacts to a great degree the amount of return you get over the next 10 years. So valuations matter, they matter a lot, and they're part of a full market cycle. And as we talked about in the past, that's the nature of investing in the markets. There will be a fantastic bull market in some years, but you are going to have to pay for the experience of that nice bull market at some point with a bear market correction. It is part of every full market cycle that encompasses investing in the markets. This is what we're watching and paying attention to. Get by the website, read the full article in the post at realinvestmentadvice.com. And of course, if you have any questions, be sure and send it to us, realinvestmentadvice.com. I'm your host, Lance Roberts, for Fundamentally Speaking today at Real Investment Advice.